Good morning. It is August 22nd. It's the day when the Federal Reserve Chairman is going to be speaking at their Jackson Hole event. He's going to be speaking in roughly 1 hour. And we're going to cut over to that to listen to his speech and keep our eye on the stock market, because today, depending on what he says, and specifically the actions that the Fed is going to take on interest rates, stocks are going to move. They're either going to move up or they're going to move down. And I don't know that they're going to go sideways. He's probably going to say some things that are going to be interpreted as really good news or bad news for stocks. And we'll see what happens. The market's sold off for the week, and we've gotten to Friday and look forward to getting some clarity from the Fed. This Fed doesn't have more than, I guess, about 7 months to go. And then he's going to be replaced, maybe 8 months. He's going to be replaced with somebody that the president replaces him with. And then we'll move on to the next chairman. So with me is Daryl. For the first hour, we're going to look at stocks. We're going to look at some things that are going on next week. And if you have a stock you want us to take a look at, put it in the chat. If you're a member of my channel, it's free of charge. If not, it's a $5 super chat. And we will look at the stock closely on fundamentals. We'll look at how it's valued, and we'll look at the charts as well. How you doing this morning, Daryl?
Doing very well, Victor. It's good to be here. Thank you.
Yeah, I really enjoy streaming with you and getting your point of view on charts. And I've certainly learned a lot. So the markets are in the pre-market up slightly. The Dow's up 0.31, S&P is up 0.22, and then the Nasdaq's up slightly. So not one direction or the other, but I think in an hour and 15 minutes, we're going to see the direction of the market for the rest of the day. So it looks like Metal Notice, good morning. Thanks for joining. The Early Bird, thanks for joining. And I think you mentioned before we went live, you saw that NVIDIA is going to be announcing next week.
Yeah,
on the
they
27th.
announced on Wednesday after the market.
Yeah, and most definitely that's going to be a good earnings. We should do a watch party if you're available. We'll stream live as we get the earnings like we did before.
Yep, that sounds good.
And dissect NVIDIA, see what the world's most valuable company had to say. The stock has been incredible. Year to date, it's up 30% for the 1 year, 37, 5 year, 1,341%. Congratulations to NVIDIA stockholders. It's been a phenomenal stock. It's up to 4.27 trillion, PE 56. That is a little expensive. The revenue growth is phenomenal. They have really grown nicely. When we look at the forecast, this is a semiconductor company. And if this revenue forecast is correct, and you got for the immediate forecast for the next, call it 2 years, you have 68 analysts, putting a forecast out there, and then 29 for 2028, and then only 6 for 2029. But you see the rate of growth is slowing down. So it's going to turn a little bit like into Apple, but not quite, because this is a cyclical stock. Will companies continue to buy these really expensive semiconductors? It's gone further and higher than I imagined. If you asked me 2 years ago, I would have said, man, there's no way NVIDIA is going to get above 2 trillion. Well, it's gotten above 4. So I was wrong. And the growth rate has persisted much longer than I imagined as well. And we'll see how long these corporations are going to be willing to spend on these data centers and how productive and profitable AI businesses end up being. So, going to be really interesting. Did you have anything to share on NVIDIA? Any charts or anything?
The only thing I can really point out, let me show you my earnings worksheet. I usually prepare for earnings by looking at the relative strength and just make an annotation whether it's negative or positive. And I usually do this the weekend prior to the earnings week. So that way I have a general idea of whether the company has positive or negative relative strength as it moves into the earnings. Then I get their estimate. Those can change up until the day of reporting. So I try to keep those as updated as possible. Then I record whether their actual value, whether they beat or missed on both revenue and earnings. I also calculate the implied move using the options market to give me an idea of what the market is expecting as far as a move in the stock. And these have been very helpful. Before I started doing this, I couldn't tell you what a stock was going to move. But now I have at least have a general idea. Haven't calculated it for NVIDIA. I'll do a video this weekend and provide that on my YouTube channel.
Excellent.
But then after they report, I report the initial response and then what's the price 1 week later and 2 weeks later. And so anyway, that's generally why I look at these. So now that I've explained that, we can look at the chart and I can see that the RSI is sitting right at the midpoint right now. So it still has positive relative strength, but it's almost to the point of moving into more negative territory. It has been positive PPO since the 7th or 8th of May. It's had several crossovers, both to the bullish side and the less bullish side. And we're currently in a less bullish configuration, but we are above the midpoint. So it's it's more bullish than bearish for sure. The one interesting thing that I see here is the accumulation is at a pretty much a 52-week high.
Mm-hmm.
And the money flow is also very positive right now.
Mm-hmm.
So as far as what people are doing with their money, that is speaking pretty loudly. So anyway, that's kind of what I'm seeing. I'll do more in a video this weekend and I'll provide the options implied move and what have you. So anybody that's interested in that kind of stuff, they'll have it available to them this weekend.
Thanks, Daryl. I will be watching. Yeah, we'll do a watch party on Wednesday after the market closes and NVIDIA announces, and we'll go through the earnings and just dissect the earnings. I'll revalue the company, and then Daryl could look at the charts. So look for a live stream notice that we're going to do a watch party on NVIDIA. It should be a good one. Last time we did a watch party, I think we got like 1,500 people watching our live stream. So that's great. Right now we've got 44. That's awesome. It's fairly early in the trading day, so I appreciate everybody joining. Thank you so much. So NVIDIA is certainly going to announce next week. Look at that. In the pre-market's down a little bit, 1.31%. So we'll see what it does today. We'll see what it does next week. So yesterday in our live stream, this little company came up, and I've been buying into small caps. I think there's good value there. And if interest rates drop, think it's going to be a good environment for small caps. Most of my net portfolio value is in bigger caps. Not Microsoft, Meta, Google Alphabet, Amazon. I've got quite a bit of Robinhood. That's not a big cap, but I've got Robinhood. And where I'm going is, yeah, I've got big caps covered, but I think I could probably find some really good stocks that do well with lower interest rates. Let me share my screen here. So Root is a company, they're an insurance company. And what we're seeing in these smaller companies is they're kind of reinventing or maybe selling financial products in a new way that really fits the times. You look at how Robinhood's doing business, they don't copy what's been done in the past and kind of try to just do it better. No, they're really changing how investors want to invest these days, right? I think about that young investor, and they grew up with a video game controller in their hands, PC in front of them. I know my sons, they're 25 and 21. They were behind a PC at the age of 2. I was behind a PC at the age of, I don't know, 16. And then I got my own PC when I was 20. So my kids are way ahead of me from a digital perspective. So Robinhood, I think, really aims at that person that's like been digital their whole life, as opposed to me. I'm a little more old school. Back to Root. The way, if you look at Root's website, they're selling insurance through a different mode and model where they want it to be kind of a self-service process. It's really fitting how a lot of these industries are seeing new companies come in that are changing the way we used to use that particular industry. Uber for taxis. I mean, who fetches a taxi these days? Even my mom takes Uber. She's 89 and she's on Uber. So this is just a different way of getting car insurance, home insurance. And I really liked what I saw last night on our live stream, so much that I'm watching and maybe might even buy this stock. You see how their experience is really elegant, real simple. That's great. I know buying insurance, car insurance, is not the funnest thing in the world. My wife handles that for our home, and boy, she handles our insurance, that category of stuff, health insurance, auto insurance, homeowners insurance. And she has to go through like just so many like wormholes of like process. And these guys are trying to make it simpler. I think it's a great idea. And when we look at their fundamentals, so business wise, kind of qualitatively, I really like Root Insurance. I think, okay, you guys have a good idea. Okay, period. But do you make a lot of money? Because I like businesses that make a lot of money. That's one of the non-negotiables. I have to see a business that's going to make a lot of money. So let's take a look at their fundamentals. So it's a small cap, 1.36 billion. Revenue is like 1-to-1, and that's typical of insurance. It's not like these guys are atypical. Over the last month, it's down 33%. Year to date, it's up 21. For the 1 year, it's up 87. For the 5 years, it's up 226. And you see how they IPO'd way back here. It may have been another SPAC or something. And man, it was at 431 and it sold off because I think the market really liked the concept. They go, hey, that's a good idea. And then it sold off. Man, did it sell off. But I'm not buying it back here. I would be buying it at $88 a share. It's up in the pre-market by 1.26%. Let's look at the financials, and where I think the market did not like that they grew at 32% and they were growing at this really fast rate 3-4 quarters ago. And their percentage growth is slowing down. part of that we would expect because the number keeps getting bigger, right? These numbers getting bigger, so it's harder to grow at the same percent. I think the market was a little concerned that, wait a second, you're slowing down quicker than we expected. It's still a good growth, 32%. Very good growth. And they're already a decent size, 1.365 billion in revenue. Not too long ago, they were 310 million. So they have gone up more than 4x. That's good. And they do free cash flow. They have profit margins. So they have really good fundamentals. And the thing I point to, I've been an Allstate investor for a couple of years, and I've been aware of insurance partly because Warren Buffett loves insurance. He bought all of Geico. That's how much he loves insurance. And there's some advantages for the insurance, right? Now, one of the things that insurance companies have to do is the acquisition cost of customers is really expensive. That's why when you're watching a football game, you'll get, insurance company commercial after insurance company commercial, is because the acquisition of customers, or maybe taking customers, Allstate taking customers from Progressive and vice versa. And it's just a very competitive market. And these guys are growing, which shows that, hey, their method of acquiring customers may be the advantage. The new way of getting customers may be a big advantage. So I went as far as doing a valuation on Root. Let me show that to you. Did it last night on the stream. And this puppy looks great. I'm not growing them overly optimistically. Like it's looking like, let me try to make this bigger here. I'm growing cash flows by 15%. They're small, so I'm going to grow long-term by 5%. I increased my discount rate to 9% since they are smaller. They have a very good balance sheet, more cash and debt, and they just have far higher value based on cash than their current market cap. If they continue to grow at 30%, 25%, this is just going to be a good winner. So I'm looking at this as potentially one of my next buys. The earnings per share, just using a PE of 12. I mean, I could easily go to 18 because it's a growth company. And on that ratio, it's not quite adding up to its stock price. But this is the number that I mainly focus on. 2/3 of my valuation focuses on free cash flow, and it has a really nice discount. So Root came out of the live stream last night. The live streams have been and continue to be a real good idea generator. And that's Root. Can you take a look at Root and tell me what you're seeing on the charts?
Sure. So they have been as high as, let me go out a little bit more here. They have been as high as the 486 when they IPO'd.
Yeah. Incredible, huh?
Yeah. And looks like they've been as low as $3.57, and they did have a reverse stock split in 22. So going in an IPO at this time was probably not a very wise choice if they had any vision into the 2022. We've seen a couple that did that. So they're currently trading at 88. Looks like they had an earnings announcement back here in October where they jumped up 68%. And they've kept rising all the way to 181 as recently as March of this year. And then we had the tariff announcements. They probably wouldn't be affected by tariffs really, but they were still down 38% during that time. Then they've recovered and they're been consolidating pretty much for the last 3 months.
Mm-hmm.
They must have had another earnings, if I was guessing.
Yeah.
Okay. So it looks like they fell about 26% on those earnings
Mm-hmm.
and have been consolidating since around this 88 price. Pretty high volume on earnings, not nearly the volume they had on this earnings,
Mm-hmm.
but it's still. I have a 50-day moving average line here.
Mm-hmm.
So their 50-day moving average looks to be about 5.5 million shares. Am I reading that right? No, 500,000.
Mm-hmm.
And they traded 667 on this day. So their RSI is towards the bottom end. They're sitting just above being oversold. Their PPO is negative. The divergence between these two moving average seems to be closing a little bit. Their relative strength and relative momentum is less than that of the S&P 500. Their accumulation, they're actually in distribution, so they had their high as far as accumulation back in September of last year.
Mm-hmm.
Money flow is currently negative, and they have outperformed the S&P 500 by 65% over the last year. They've outperformed the financial sector by 53% over the last year. The insurance, property, casualty insurance industry group, they have also outperformed while the industry group has underperformed this S&P 500 by just minus 3%.
Mm-hmm.
So
Yeah. So I'm going to be watching this stock, and I'm not buying any stocks for the next hour or so.
no.
I'm not selling any stocks in the next hour. I'm going to wait for the chairman of the Federal Reserve to talk, and then we'll see what we're dealing with. But this one's probably going to be a stock that I buy, and I like the growth. The growth looks fantastic. And again, insurance. It's if you look at Progressive, their stock is doing great, and they're growing at like 10, 12%. Allstate's doing well. They're growing, single high digits. So these insurance companies, they make money. Insurance business is very hard. Or I should say, the actuarians have to know really complex mathematics. But once you have the right actuarians, it's almost guaranteed you're going to make money. So there's few industries that are like that. Now, the next stock that we could look at, it's a stock that Mike, the dividend investor guy, wants us to take a look at, and that's HAFN. That's HAFN. This is a company that operates oil product tankers in Bermuda. So it's moving oil around, and oil hasn't been very high, and the movement of oil, I have to guess that isn't a lot of movement. I know that China is one of the scarcities that they have in China is they don't have enough oil, so I'm sure they're having to move it up there. The Chinese economy is doing well. I've looked at the China markets like the Hang Seng and then the Shanghai indexes. They're doing really well. Commerce in China is happening, so the movement of oil I expect is doing well. into China. But that's the only, I think, big factor that I would think is producing revenues for Hafnia. This stock is up 5.5% year to date, and it pays this huge dividend, 15.56. So you're doing okay year to date. For the 1 year, you're not doing okay. You're losing a little bit of money. You're losing a little bit of your investment. Over the 5 year, it's interesting that it was way down here for a long time. Then all of a sudden, it just took off. So, or maybe they IPO'd here. I'm not sure what happened here. It's interesting to see a flat line. So this one here, this is not a stock that I would expect is going to continue to increase in market cap like a Microsoft that, hey, 20 years ago was $250 billion in market cap. Now it's 3.8 trillion. I mean, it just continued to go up in value. That's not where I think Hafnia is going to go. These guys will, depending on how oil markets are, it may be a really great year for profits. It may be a terrible year. It just goes back and forth. So getting in and getting out is really important on a stock like this. Get in when the price is really low and you expect the environment for the next year or two is going to be good for Hafnia. Get in, make your money, and get out. Because if you try to stay too long, you may see your profits go away. So Hafnia is an interesting stock. Let's take a look at the revenues real quick. So the revenues are down the trailing 12 months. Yeah, this isn't a giant surprise. I think with low oil prices, I just don't think the volumes are very high. That's why oil is down. So you're seeing the revenue go down for that in those 2 quarters. And so yeah, those are my comments on Hafnia. Do you have charts on Hafnia?
Yeah, so they are trading lower than they were the 1 year ago. They're trading above their 20-day, 50-day, and 200-day. It looks like the 50-day and the 20-day are upward moving, while the 200-day is declining at the moment. The RSI is 64.85. The PPO is positive, and yesterday we had a bullish crossover based on this price movement yesterday of 5.38%. As far as momentum and relative strength, they're sitting about where the SPX as a whole is sitting. Accumulation is at a 50, well, not quite a 52-week low, but it's pretty close. It was lower back in March and April. The money flow is negative, and it looks like they've underperformed the S&P 500. Looks like they've underperformed the industrial group, slightly outperforming marine transportation by 4.5%, and marine transportation industry group overall is trailing the S&P 500 by 26%. I've only owned 3 shipping companies. I own 2 lessers. So DAC is one that I owned in the past, and Global Ship Lease is one I've owned in the past, and I've also owned Zim. But I don't hold any of those currently.
Looks good. So I'm reading the chat, and I would say that Chairman Powell is not receiving a lot of positive comments so far. And I think that he's been super conservative, and that's been to the detriment of the stock market. We'll see what happens. We'll see what happens today. I have no idea what he's going to say.
The market just opened, and the Dow at least shot up.
Really?
jumped up about 40 points over the pre-market numbers.
Yeah, it's up 0.55. Looks good. Looks good. Not bad. But in an hour, we'll really know what the market's going to do today. It's up. The Dow's up 0.61%. S&P up a little, 0.25. NASDAQ is up slightly, and the Russell, now it's down. Russell's up a little bit. So, any other big news out there? Pinduoduo stock price is up. Nice. All right. So, United Healthcare. Let's talk about United Healthcare for a minute. It is up today, 1.37. This stock, it's above $300 per share, which is good. I mean, not too long ago, this thing was just way down, 237. So it's up nicely. A lot of news around, big investors taking positions in United Healthcare. The stream of negative news for the moment has stopped. It's like measured in weeks. We'll see if any bad news comes up again. And as I've mentioned, I've been talking about United Healthcare for months. Heavily discounted stock. This is a blue chip stock. We're dealing with a company that was right up there. It's like Procter and Gamble, Johnson and Johnson, United Health Group. It's like a really, really good business. And the market decided, no, it's not a really good business. Sell it off by 50%. Well, I see it as an opportunity, and I've been buying into it quickly. Revenue growth looks good. Let's take a look at, I'm going to let you handle the charts, but let me see if any forecasts have been updated by these analysts. 23 analysts cover it. And some analysts are agreeing with my thesis, which is this stock's going to get back to 600. And this analyst is saying it's going to go up to 700. And some analysts are still careful with this stock, and they're saying, no, the stock's worth 198. Overall, consensus is the stock's discounted by close to 30%. When we look at their forecasts, they're going to keep growing, and then they're going to be flat in 2028. But this kind of growth, and I'm not sure I agree with these numbers, but that's fine. I would be fine with them growing at 6%. They're so big. They're $450 billion in revenue. 6% growth on that is 25 billion or so. That's a really good growth rate if you measure it in dollars. So overall, I think this one here is going to be interesting to follow. It has been interesting to follow. It's up nicely, 1.86. It had kind of a little bit of a sell-off. It just took off, right? Had the news that Warren Buffett and Michael Burry, David Tepper, Chase Coleman, a lot of super investors are in now. And then it jumped up and it kind of came back down, but now it's looking to move higher again. So United Health up 2%. Nice. So let me pass it over to you. Let me wish little Jay a good morning. Thanks for joining. Saeed, great to see you. And Mike making a move on HAFN. Over to you, Daryl.
Okay, so we've looked at UNH several times. And on the 13th, right before all those 13Fs were filed, we looked at a short-term trend line, and it had broken out above that on the 13th, which was the day before we all knew what those 13Fs were. And then on the 14th, 15th is, so we knew about those then, and it shot up 12% on that day. And one of the problems was with that, if you look to the left, these bars right here is price by volume. So anybody that had bought up here and experienced a drop to 234, short-term investors would have been looking to maybe sell and get out. So I expected we would have some resistance, even though the news from all those big investors was very positive and supportive of UNH. In the short term, we would be fighting these stranded longs.
Mm-hmm.
So far, that's played out. Yesterday, let me zoom in here. You can see this particular candle. The body is centered in the middle, and then you have a long upper tail and a longer lower tail. So indicating a lot of indecision yesterday, and it candle body also stayed within the body of the previous day. So there seemed to be just a lot of indecision yesterday. And
Mm-hmm.
today we're getting a little pop of 1.9% at the moment.
The stock did rise yesterday, right?
Barely, yes. It was up yesterday.
Interesting.
So, yeah. As long as we can hold about 288 or so, I think we're in good shape on UNH for a longer term.
Mm-hmm.
The RSI has definitely moved higher. We were way oversold on the 4th of August. And
Mm-hmm.
even with the news of the big investors, we didn't go into overbought condition. We're sitting about 64. The shorter term average in the PPO is positive now, so we're above zero. The longer term average, the red line, is still below zero, but that is starting to look fairly good. The relative strength and relative momentum to the S&P 500 are both better than the S&P 500. Interesting that most of the accumulation occurred at this price around 299 or
Mm-hmm.
so. So there was a lot of accumulation at that time. We haven't quite reached back to that point. Money flow is still negative, and we know it's underperformed all of my standard things
Yeah.
that I look at down here. But I still think we're in good shape. I'm also an investor. I'm in it around 288 on average.
Mm-hmm.
So that's a price I'm looking for, and it seems to be supportive of this line about right here. So I think we're in good shape with UNH in the long run.
Very good. Yeah, this is. I find UNH really interesting because it's in the last 8 months. I mean, this stock's been places, right? It's down on the dumps, and if it picks itself up, this may be another example of how the market at times is irrational. It's irrational in both directions. It's like sometimes, a stock is priced really high and the market's just crazy about it. Um, and then it comes down, right? Don't want to name a stock for now, but um, the point. And on the downside, the market just sells off like really quality businesses, Meta, Netflix, um, and now United Healthcare. And it'll be interesting to see how this thing operates, especially if it starts to climb. It'll be a interesting stock to follow because I think we could all learn something from it, which is, yeah, the market behaves irrationally in both directions. And now you can be a spectator or you can be an investor and you can make money. If you see these situations arise, There's nothing wrong with buying Meta stock at $85 a share and then watching it go up to 700 and some odd dollars. Netflix, it got taken down, and we can go on and on. The latest stock that took that type of course is United Healthcare. So I really enjoy watching it, and hopefully it'll continue to rise.
Yeah, there's been a lot of volume too. If you look at this volume lines, it was pretty steady for, 7 or 8 months. But you can see when it started selling off here, the volume really shot up. A lot of those were down days, but you can definitely see a lot of buying days as well. But the average daily volume has, I don't even know what it is back here, but it has gone up a lot.
So Carlos has got an interesting comment. He's a student of the game. UNH reminds me of the MX, American Express scandal of the 1960s. It sold off. Buffett jumped in. Yeah. So bad news brought down American Express. Buffett has owned American Express forever. So good comment. Thanks, Carlos. Student of the game. I wasn't in the market in the 1960s very much.
Weren't they diluting oil some way?
American American Express
Yes, I think so. It
diluting
was
oil.
it was can't remember exactly what it was. I remember hearing that story though.
Yeah. Interesting. All right. So another member, Little J, wants us to take a look at CPRT. So let's look at CPRT, see what this business is all about. And man, we've got a lot of people watching our stream. We've got 108 folks on the stream. Thanks, everybody. Thanks for spending a part of your morning with us. We're doing some stock reviews, analyzing stocks. And then when the Fed chairman speaks at 10 a.m. Eastern, which is in about 18 minutes, we're going to cut over to that, hear what he has to say, watch the markets, and see what's going to happen for the remainder of the day. All right, so let's take a look at CPRT. This is Copart. And they provide online auctions, vehicle remarketing services in the United States, Canada, United Kingdom, Brazil, and the Republic of Ireland, Germany, Finland, United Arab Emirates, Oman, Bahrain, and Spain. So they process cars, I guess, that go into the wholesale market, and then they sell them to dealers and so forth. Take a peek at their website here, Copart. So how it works, 100% online auto auctions, over 5 million used. Okay, so you have to become a member, and then you can bid on a used car. I imagine that some like small business, like some people like to, some individuals start a little business, maybe a side hustle where they buy a car, recondition it, and then sell it for a profit. I get that. I was turning wrenches when I was 11 years old. I have older brothers, and I remember working on Volkswagens and Toyotas and Nissans with their direction. I didn't know what I was doing at 11, but that was really fun. And I can totally get people wanting to do this as a side hustle. That's not me. I'm not good enough. My older brothers I have an older brother that, man, he can fix anything, but not me. All right. So we've got this company. You can become, so you can get the data for free. You become a member. You can bid on cars. And then if you become a real high priced member, is this per month or per year? All right. So probably per month. So interesting. This is a good idea. This is a very good idea. So they're running basically a member-driven company. So, and they're putting cars now. The used car market again is becoming quite valuable because car prices are just so darn expensive. I don't know if you shopped for a car recently. It's like it's impossible to be under 30 grand for a new car. It's like you have like literally like two choices. It's either that car or this car. Everything else is 30. You get up to 60,000 if you buy an SUV, full size SUV. It's really hard to get under 60 grand. Car prices are really expensive. And the good news is they're lasting a lot longer. So the used vehicle market continues to get more attention, more commerce. So it's looking good. All right. So I'm glad I looked at their website because I was going to go down the wrong road. I just thought they did auctions, and I'm somewhat vaguely familiar with that process, which is, you have these wholesale auctions, dealers go to them, they buy cars, but instead, these guys are actually operating a website where they're selling subscriptions to their website, and then they make money on that subscription. I like that model. It's probably very profitable. $46.5 billion in market cap. This year, they're down 15.82 over the 5-year. They're up 92. They've had a pretty good pullback this year. Over the 1 year, 7%. You see that pullback. Probably driven by some earnings announcement that happened around that time. They have 4.59 billion in revenue, so they're about 10 times revenue is what you're paying for the company. PE is at 32. That is a little expensive. We'll see how they're growing. Analysts think it's a little discounted. They are growing. That's good growth, 10% on a $4.5 billion revenue number. That's good growth. All right. Let's take a look at profit margins and cash flow. Profit margins, now that is a surprise. They're an online business selling subscriptions. I'm sorry, I'm looking at the wrong line. So gross margins are 46. So that is a little low because I would have thought that they'd be a little higher, but still the profit margin is very good at 32. 32. Free cash flow margin is very good at 25. So this looks good. Yeah, this business kind of high level. I'd probably say that it's worth 25 to 30 billion, maybe higher. But the growth isn't great. And let's take a look at their balance sheet. Make sure they don't have too much debt. They don't. They have $4 billion of cash. So that looks good. They are priced quite high from a market cap perspective. 46 billion seems a little high. Let me turn it over to you. You can take a look at the charts. I'm going to work on a valuation while you do that, and then we'll come back to a valuation.
Okay, so they've been as high as 64 back in November of last year. They must have an earnings report about this time, and they went up for 3 days after that earnings report. That's in sharp contrast if this is another earnings where it didn't go down for 3 days. It just kept going down. Got a little volatile and now sitting around 48. So you have a declining 200-day moving average, a declining 50-day, and a rising 20. And it is trading above the 50-day moving average at the moment. The RSI is positive at 59. The shorter term PPO average is above the midpoint. The longer term average has not yet moved into positive territory. Sitting about even with the S&P 500 on the relative strength and relative momentum. The decumulation or distribution reached low in July 22nd, and the 31st has moved off that bottom slightly, but nowhere near the peak back in May the 16th. The money flow is positive and it's sitting above 0.05, so it's considered bullish at the moment. It has underperformed the S&P 500 by 19% over the last year and underperforming the industrial sector by 23%. For some reason, the industry data is not showing up. That would be the industry group.
Mm-hmm.
So they look a little challenged right now, in my opinion, but let's look at those fundamentals a little bit more.
Yeah. So I've got part of it done. So let's flip back to my screen. So on cash flow, it's not looking like it's discounted. It's actually looking like it's priced at a premium. The growth rate isn't incredible. It's 10%, which is good. It's just not great. And if you're going to be priced really high, then you're going to have a high growth rate. Shares outstanding 966. Yeah, they're priced at a 15% premium based on cash flow, and I'm giving them an 8% discount rate, and I could go higher, but I'm going to imagine the future has lower interest rates, so I'm going to go with 8%. And 10% growth, they're growing at 10%, long-term growth at 4%. Earnings per share wise, let's see what earnings per share looks like. And I'm going to use their fiscal year ends July 31st, 2025. So they just finished that year. And I'm going to use next year's 2026, or I should say the current fiscal year since we're already in it. That's $1.76. PE ratio, this is a growing business. Give them an 18, and they're growing that by 12%. So rather than going with the full amount, I'm going to go with 8. Yeah, this is not floating my boat. It's just priced a little too expensively. And maybe the market knows that it's priced a little expensively and it's really correcting it. Now, the market tends to get captivated by stories, and the stories around car prices are there, which is, hey, used car markets look good. They look really good. And the market probably trades on it. Like, hey, let's go buy Copart because they're involved in used cars, and the market gets a little bit of enthusiasm there. But the stock price, the fundamentals just don't support the stock price at this time. It's beginning to really correct. So that is Copart. Hopefully you found that interesting, little J. Answers your question on Copart. Thanks for being a member. Appreciate it. Man, we got a lot of members on. Thanks so much, everybody, for joining. Thank you for the questions. Mike, the dividend investor guy, is working on his HAFN stock. Sam, good to see you. Good morning. James Greaves. Copart mainly disposes of insurance vehicles. Okay, so you're buying a vehicle that has been damaged. So you might have a salvage title involved. You recondition it and sell it. So the market's really elevating right now. What's going on, stock market? Whoa. Maybe somebody ran into Chairman Powell in Jackson Hole at the local Starbucks, and he was in a really good mood. And they're like, hey, Chairman Powell's in a good mood. Let's buy stocks. I don't know. For now, we'll see if the market knows. The market has its senses, but the S&P is down. Is that right? Okay, Google's disagreeing with CNBC. This looks more accurate. Everything's up. Okay, good.
Yeah.
SS Smurf, good morning, sir. Thanks for joining. And then Mike, glad to see Pfizer's been rising lately. I know I have.
Let's
noticed it.
let me take a look at that chart.
Let's
I've
do
been
it.
watching this one very closely. And the reason for that is we dropped down to like $20 here, and we were in the same position with PFE as Pfizer as we were with UNH, where we have a lot of stranded longs right here at about 25, which is also the top. Well, I'm pointing at the screen and you can't see what I'm pointing at. We have four tops here that aligns with that level. So I thought we would probably hit resistance and then fade a little bit. The good news, Mike, is we've actually broken above that level and that stranded long level. So we could be in for, if we can hold that now without dropping back down below it, we could be in for a move maybe on Pfizer.
Nice. And
They're not
Pfizer,
they're not overbought. They have a positive PPO, positive momentum, and relative strength compared to the S&P 500. Accumulation is still low. They have positive money flow that isn't quite bullish yet, but almost there. So this is starting to look pretty good, Mike. We really need to watch that level right there and see if it can hold that level.
and
Is
for
that
those investors that like dividends, Pfizer right now is paying a 6.6% dividend, and I believe they can afford it. The reason it's gotten so high is that the stock price has really come down, while Pfizer is actually expanding their profitability. Their top line isn't growing very well. Their revenue is pretty much flat. But if you focus on the bottom line profitability, that's really growing fast. And that's some investors really like that. If you're a dividend investor, Pfizer's looking like a pretty neat stock because you're going to pull that dividend. The stock's fairly safe compared to, maybe a tech stock. It's an established business with established drugs that people need. It has a pretty decent portfolio of new drugs. So that's looking pretty good. We're 2 minutes from the chairman, I believe, starting his speech. And I'm watching Bloomberg on my other screen here. Once we have him talking, I'll cut over that. Let's see here. So we've got Pfizer on the board. We got 160 viewers. Thanks everybody for joining. We just looked at a good string of stocks, including Pfizer, Copart. We looked at United Healthcare. We looked at Root. We talked about Zim, but we didn't look at it. We looked at HAFN, and I know we looked at another one before that. No, I think that was it, HAFN. And we talked about NVIDIA. NVIDIA is going to have a big week coming up. What's NVIDIA stock doing right now? It is down a little bit, down 0.7%. So it's down a little bit. If I look at the heat map, let me cut over to my screen to show the heat map. Okay. Man, it looks pretty green out there. It's like a beautiful garden. Amazon's down. NVIDIA's down. Palantir's down. Microsoft's down. Intuit's down. Man, Intuit has really been selling off. But there's a lot of green out here. It is a green all over the place. Somebody spray painted this heat map green. Meta stopped selling off. That's good to see. It was selling off every day 2%, 2%, 1%, just selling off, but it's still having a good year. So long as it stops the bleeding, I'll be okay there. That's my biggest holding. So it certainly catches my attention when it's doing that. All right, let me see what's going on with the fair. Nope, we're still there. I've got it on mute. Let me do a sound check really quick. Let me know if you can hear it.
Based on what we think is going to happen, and they're going to say we're going to look at.
Can you hear it?
Sounds great.
All right. Well, these guys are in Jackson, Wyoming. I went to Jackson, Wyoming. Must have been 20 years ago. No, about 18, 19 years ago. It was a really nice family trip. Beautiful place. I went in the summer. And then we went into Yellowstone. So we had a good time. It was the first time that we ate elk. I don't know if you've had elk.
It's delicious.
I'd never had elk, and check the box. The only thing that I'm not going to have elk all that often because it was expensive. They give you a small steak, and it was expensive. And if you're in Wyoming, like we went into Montana, and they gave us a steak that was like a massive steak for a very reasonable price. And the beef was delicious. I mean, they're ranching, they have their cows nearby. And so that was a better meal, but it was neat to have elk. I mountain biked the Grand Tetons, and we also took a boat ride across this lake and hiked the Tetons. That was really fun. It was a great trip. Went into Yellowstone, ran into a wolf pack. That was neat. We didn't get out of the car. We just watched them from afar. All right, so it's 10:02. All right, what's going on? Let's kind of watch the coverage a little bit.
Perhaps at a slower pace. So right now we are looking at Fed that has the door open for a September 17th cut. And I guess, Lisa, we're probably going to see the long end and the short end reacting here.
Well, let's pull that up right now. You do see an absolute catering in yields on the heels of this opening up to the potential for rate cuts coming out. The downside risks to employment are rising. What you can see also rising. The S&P 500 now up 1.3%, yield
nice.
down 8 basis points on the long end for the 10-year, even more for the 2-year.
And looking at the inflation-adjusted yield, the 10-year real yield comes in 6 basis points.
I knew it was going to be a good day.
It's still within the range, but at 1.86%, it's a real reversal towards a presumption of Fed accommodation.
Yeah, and this comes at a time where there is this question of how they are going to message this, given that inflation has remained above that 2% target since 2021. Mike, do we hear anything about why this is a Fed willing to look through that kind of inflation?
They do anticipate that tariffs are going to add to inflation, and they think it will take place over time, but they're still looking, at least as Chairman Powell puts it, they're still looking at these as one-time price adjustments within each sector. So it's likely that inflation is going to go up, but then they think it stabilizes and might go down again.
All the indices are up at least 1%.
Absolutely.
In my remarks today, I will first address the current economic situation and the near-term outlook for monetary policy. I will then turn to the results of our second public review of our monetary policy framework as captured in the revised Statement on Longer Run Goals and Monetary Policy Strategy that we released today. When I appeared at this podium 1 year ago, the economy was at an inflection point. Our policy rate had stood at 5.25% to 5.5% for more than a year. That restrictive policy stance was appropriate to help bring down inflation and to foster a sustainable balance between aggregate demand and supply. Inflation had moved much closer to our objective, and the labor market had cooled from its formerly overheated state. Upside risks to inflation had diminished, but the unemployment rate had increased by almost a full percentage point, a development that historically has not occurred outside of recessions. Over the subsequent 3 Federal Open Market Committee meetings, we recalibrated our policy stance setting the stage for the labor market to remain in balance near maximum employment over the past year. This year, the economy has faced new challenges. Significantly higher tariffs across our trading partners are remaking the global trading system. Tighter immigration policy has led to an abrupt slowdown in labor force growth. Over the longer run, changes in tax, spending, and regulatory policies may also have important implications for economic growth and productivity. There is significant uncertainty about where all of these policies will eventually settle and what their lasting effects on the economy will be. Changes in trade and immigration policies are affecting both demand and supply. In this environment, distinguishing cyclical developments from trend or structural developments is difficult. This distinction is critical because monetary policy can work to stabilize cyclical fluctuations, but can do little to alter structural changes. The labor market is a case in point. The July employment report, released earlier this month, showed that payroll job growth slowed to an average pace of only 35,000 per month over the past 3 months, down from 168,000 per month during 2024. This slowdown is much larger than assessed just a month ago, as the earlier figures for May and June were revised down substantially. But it does not appear that the slowdown in job growth has opened up a large margin of slack in the labor market, an outcome we want to avoid. The unemployment rate, while edging up in July, stands at a historically low level of 4.2% and has been broadly stable over the past year. Other indicators of labor market conditions are also little changed or have softened only modestly, including quits, layoffs, the ratio of vacancies to unemployment, and nominal wage growth. Labor supply has softened in line with demand, sharply lowering the break-even rate of job creation needed to hold the unemployment rate constant. Indeed, labor force growth has slowed considerably this year with the sharp fall off in immigration, and the labor force participation rate has edged down in recent months. Overall, while the labor market appears to be in balance, it is a curious kind of balance that results from a marked slowing in both the supply of and demand for workers. This unusual situation suggests that downside risks to employment are rising. And if those risks materialize, they can do so quickly in the form of sharply higher layoffs and rising unemployment.
Russell's up 2%.
At the same time, GDP growth has slowed notably in the first half of this year to a pace of 1.2%, roughly half the 2.5% pace in 2024. The decline in growth has largely reflected a slowdown in consumer spending. As with the labor market, some of the slowing in GDP likely reflects slower growth of supply or potential output. Turning to inflation, higher tariffs have begun to push up prices in some categories of goods. Estimates based on the latest available data indicate that total PCE prices rose 2.6% over the 12 months ending in July. Excluding the volatile food and energy categories, core PCE prices rose 2.9%, above their level of a year ago. Within core, prices of goods increased 1.1% over the past 12 months, a notable shift from the modest decline seen over the course of 2024. In contrast, housing services inflation remains on a downward trend, and non-housing services inflation is still running at a level a bit above what has been historically consistent with a 2% inflation. The effects of tariffs on consumer prices are now clearly visible. We expect those effects to accumulate over coming months with high uncertainty about both timing and amounts. The question that matters for monetary policy is whether these price increases are likely to materially raise the risk of an ongoing inflation problem. A reasonable base case is that the effects will be relatively short-lived, a one-time shift in the price level. Of course, one time does not mean all at once. It will continue to take time for tariff increases to work their way through supply chains and distribution networks. Moreover, tariff rates continue to evolve, potentially prolonging the adjustment process. It's also possible, however, that the upward pressure on prices from tariffs could spur a more lasting inflation dynamic, and that is a risk to be assessed and managed. One possibility is that workers who see their real incomes decline because of higher prices demand and get higher wages from employers, setting off adverse wage price dynamics. Given that the labor market is not particularly tight and faces increasing downside risks, that outcome does not seem likely. Another possibility is that inflation expectations could move up, dragging actual inflation with them. Inflation has been above our target for more than 4 years and remains a prominent concern for households and businesses. Measures of longer-term inflation expectations, however, as reflected in market and survey-based measures, appear to remain well anchored and consistent with our longer-run inflation objective of 2%. Of course, we cannot take the stability of inflation expectations for granted. Come what may, we will not allow a one-time increase in the price level to become an ongoing inflation problem. So, putting the pieces together, what are the implications for monetary policy? In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. Our policy rate is now 100 basis points closer to neutral than it was a year ago, and the stability of the unemployment rate and other labor market measures allows us to proceed carefully as we consider changes to our policy stance. Nonetheless, with policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. Monetary policy is not on a preset course. FOMC members will make these decisions based solely on their assessment of the data and its implications for the economic outlook and the balance of risks. We will never deviate from that approach. So, turning then to my second topic. Our monetary policy framework is built on the unchanging foundation of our mandate from Congress to foster maximum employment and stable prices for the American people. We remain fully committed to fulfilling our statutory mandate, and the revisions to our framework will support that mission across a broad range of economic conditions. Our revised statement on longer-run goals and monetary policy strategy, which we refer to as our consensus statement to save time, describes how we pursue our dual mandate goals. It is designed to give the public a clear sense of how we think about monetary policy, and that understanding is important both for transparency and accountability, and for making monetary policy more effective. The changes we made in this review are a natural progression grounded in our ever-evolving understanding of our economy. We continue to build upon the initial consensus statement adopted in 2012 under Chairman Ben Bernanke's leadership. Today's revised statement is the outcome of the second public review of our framework, which we conduct at 5-year intervals. This year's review included 3 elements: Fed Listens events at reserve banks around the country, a flagship research conference, and policymaker discussions and deliberations supported by staff analysis at a series of FOMC meetings. In approaching this year's review, a key objective has been to make sure that our framework is suitable across a broad range of economic conditions. At the same time, the framework needs to evolve with changes in the structure of the economy and our understanding of those changes. The Great Depression presented different challenges from those of the Great Inflation and the Great Moderation, which in turn are different from the ones we face today. At the time of the last review, we were living in a new normal, characterized by the proximity of interest rates to the effective lower bound, or ELB, along with low growth, low inflation, and a very flat Phillips curve, meaning that inflation was not very responsive to slack in the economy. To me, a statistic that captures that era is that our policy rate was stuck at the ELB for 7 long years following the onset of the global financial crisis in late 2008. Many here will recall the sluggish growth and painfully slow recovery of that era. It appeared highly likely that if the economy experienced even a mild downturn, our policy rate would be back at the ELB very quickly, probably for another extended period. Inflation and inflation expectations could then decline in a weak economy, raising real interest rates as nominal rates were pinned near zero. Higher real rates would further weigh on job growth and reinforce the downward pressure on inflation and inflation expectations. triggering an adverse dynamic. The economic conditions that brought the policy rate to the ELB and drove the 2020 framework changes were thought to be rooted in slow-moving global factors that would persist for an extended period. And they might well have done so, if not for the pandemic. The 2020 consensus statement included several features that addressed the ELB-related risks that had become increasingly prominent over the preceding 2 decades. We emphasized the importance of anchored inflation, longer-term inflation expectations to support both our price stability and maximum employment goals. Drawing on an extensive literature on strategies to mitigate risks associated with the ELB, we adopted flexible average inflation targeting, a makeup strategy to ensure that inflation expectations would remain well anchored, even with the ELB constraint. In particular, we said that following periods when inflation had been running persistently above 2%, appropriate monetary policy would likely aim to achieve inflation moderately above 2% for some time. In the event, rather than low inflation in the ELB, the post-pandemic reopening brought the highest inflation in 40 years to economies around the world. Like most other central banks and private sector analysts, through year-end 2021, we thought that inflation would subside fairly quickly without a sharp tightening in our policy stance, as this slide will show. When it became clear this was not the case, we responded forcefully, raising our policy rate by 5.25 percentage points over 16 months. That action, combined with the unwinding of pandemic supply disruptions, contributed to inflation moving much closer to our target without the painful rise in unemployment that has accompanied previous efforts to counter high inflation. This year's review considered how economic conditions have evolved over the past 5 years. During this period, we saw that the inflation situation can change rapidly in the face of large shocks. In addition, interest rates are now substantially higher than was the case during the era between the global financial crisis and the pandemic. With inflation above target, our policy rate is restrictive, modestly so in my view. We cannot say for certain where rates will settle out over the longer run, but their neutral rate may now be higher than during the 2010s, reflecting changes in productivity, demographics, fiscal policy, and other factors that affect the balance between saving and investment. During the review, we discussed how the 2020 statement's focus on the ELB may have complicated communications about our response to high inflation. We concluded that the emphasis on an overly specific set of economic conditions may have led to some confusion, and as a result, we made several important changes to the consensus statement to reflect that insight. First, we removed language indicating that the ELB was a defining feature of the economic landscape. Instead, we noted that our monetary policy strategy is designed to promote maximum employment and stable prices across a broad range of economic conditions. The difficulty of operating near the ELB remains a potential concern, but it is not our primary focus. The revised statement reiterates that the committee is prepared to use its full range of tools to achieve its maximum employment and price stability goals, particularly if the federal funds rate is constrained by the ELB. Second, we returned to a framework of flexible inflation targeting and eliminated the makeup strategy. As it turned out, the idea of an intentional moderate inflation overshoot had proved irrelevant. There was nothing intentional or moderate about the inflation that arrived a few months after we announced our 2020 changes to the consensus statement, as I acknowledged publicly in 2021. Well-anchored inflation expectations were critical to our success in bringing down inflation without a sharp increase in unemployment. Anchored expectations promote the return of inflation to target when adverse shocks drive inflation higher and limit the risk of deflation when the economy weakens. Further, they allow monetary policy to support maximum employment in economic downturns without compromising price stability. Our revised statement emphasizes our commitment to act forcefully to ensure that longer-term inflation expectations remain well anchored to the benefit of both sides of our dual mandate. It also notes that price stability is essential for a sound and stable economy and supports the well-being of all Americans. This theme came through loud and clear at our Fed Listens events. The past 5 years have been a painful reminder of the hardship that high inflation imposes, especially on those least able to meet the higher costs of necessities. Third, Our 2020 statement said that we would mitigate shortfalls rather than deviations from maximum employment. The use of shortfalls reflected the insight that our real-time assessments of the natural rate of unemployment, and hence of maximum employment, are highly uncertain. The later years of the post-global financial crisis recovery featured employment running for an extended period above mainstream estimates of its sustainable level, along with inflation running persistently below our 2% target. In the absence of inflationary pressures, it might not be necessary to tighten policy based solely on uncertain real-time estimates of the natural rate of unemployment. We still have that view, but our use of the term shortfalls was not always interpreted as intended, raising communications challenges. In particular, the use of shortfalls was not intended as a commitment to permanently forswear preemption or to ignore labor market tightness. Accordingly, we removed shortfalls from our statement. Instead, the revised document now states more precisely that the committee recognizes that employment may run at times above real-time assessments of maximum employment without necessarily creating risks to price stability. Of course, preemptive action would likely be warranted if tightness in the labor market or other factors pose risks to price stability. The revised statement also notes that maximum employment is the highest level of employment that can be achieved on a sustained basis in a context of price stability. This focus on promoting a strong labor market underscores the principle that durably achieving maximum employment fosters broad-based economic opportunities and benefits for all Americans. The feedback we received at Fed Listens events reinforced the value of a strong labor market for American households, employers, and communities. Fourth, consistent with the removal of shortfalls, we made changes to clarify our approach in periods where our employment and inflation objectives are not complementary. In those circumstances, we will follow a balanced approach in promoting them. The revised statement now more closely aligns with the original 2012 language. We take into account the extent of departures from our goals and the potentially different time horizons over which each is projected to return to a level consistent with our dual mandate. These principles guide our policy decisions today, as they did in the 2022 to 24 period, when the departure from our 2% inflation target was the overriding concern. In addition to these changes, there is a great deal of continuity with past statements. The document continues to explain how we interpret the mandate Congress has given us and describes the policy framework that we believe will best promote maximum employment and price stability. We continue to believe that monetary policy must be forward-looking and consider the lags in its effects on the economy. For this reason, our policy actions depend on the economic outlook and the balance of risks to that outlook. We continue to believe that setting a numerical goal for employment is unwise because the maximum level of employment is not directly measurable and changes over time for reasons unrelated to monetary policy. We also continue to view a longer run inflation rate of 2% as most consistent with our dual mandate goals. We believe that our commitment to this target is a key factor, helping keep longer term inflation expectations well anchored. Experience has shown that 2% inflation is low enough to ensure that inflation is not a concern in household and business decision making, while also providing a central bank with some policy flexibility to provide accommodation during economic downturns. Finally, the revised consensus statement retained our commitment to conduct a public review roughly every 5 years. There's nothing magic about the 5-year pace. That frequency allows policymakers to reassess structural features of the economy and to engage with the public, practitioners, and academics on the performance of our framework. It is also consistent with several global peers. To wrap up, I want to thank President Schmid and all of his great Kansas City staff who work so diligently to host this outstanding event annually, counting a couple of virtual appearances during the pandemic. This is the 8th time I've had the honor to speak from this podium. Each year, this symposium offers the opportunity for Fed leaders to hear ideas from leading economic thinkers and focus on the challenges we face. The Kansas City Fed was very wise to lure Chair Volcker here to this national park more than 40 years ago, and I am so proud to be part of that tradition. Thank you very much.
I'll clap to
That was
that.
Fed Chair Jerome Powell wrapping up his annual Jackson Hole remarks. What a Jackson.
Well, there you have it. I knew it was going to be a great day, a day when good things were going to happen. And look at that. Just a couple of stocks in the red.
What are those?
Intuit and Workday.
Okay.
But just about everything. And I saw a comment from Shadow Guy that he got into Costco. Not a bad idea. Everything's moving up, but safety stocks are moving down. My only red stock today is Kroger, the big grocery company, and that's a winner. It's up more than 100% over 5 years, and it pays me a dividend, so I'm fine with it. But it's a day like this when consumer staples, you see PM down, Coca-Cola's down, Costco's down, Kroger's down, as mentioned. But man, look at this glorious heat map. We've got Google's up 2%. United Healthcare has maintained its gain. Tesla's up 4.46. Uber's up. Apple's up. Home Depot's up because lower interest rates. People are going to be like, yeah, I'll get a loan on my home, an equity loan, and I'll redo that kitchen. That kind of behavior. Qualcomm, nice to see it up 3%. Texas Instruments up more than 3%. Financials are up. Looks like the credit card companies are up nicely. Asset managers are up nicely. Boy, really, really good day. Coinbase is up substantially. What is going on in cryptocurrency land? Let's take a peek. So Bitcoin is up 2.31%. Ethereum's not showing anything right now, but that's a pretty good gain. Very good gain. So I think good things are happening today. You know, the one stock that announced yesterday that I'd like to get to once I hear your comments on the market at large and what you heard from the federal chairman is Zoom. But let's hold up a little bit, and I'm going to hold off on Zoom for a minute. What do you think of the Federal Reserve's chairman speech and highlights? I don't think there were any lowlights that you heard.
No, it's interesting that they're adjusting their policy so close to him stepping down. But it sounded like to me that they kind of realized that they're late, which I've been thinking they were late for quite some time.
Mm-hmm.
So I'm glad that they're making these changes. I did see that the FedWatch tool jumped back up to where it was last week. It's still not as high as I thought it would be at this point, but it's up to 87% or so. I can show that.
Yeah, go for it. You've got the screen.
FedWatch, there we go.
And what's
So
the rate cut that we're expecting? 50 basis points or 25?
25.
Okay.
Yeah. So this was at 58 a month ago. It's sitting at 91.5 now. I had seen it up as high as 99.9 at one point. And then I heard someone else mention that they had seen it get up to over 100%, which would have indicated a 50% basis point cut. And then it dropped down to 85 1 week ago. Yesterday it was at 75, and today we're back up to 91.5.
Okay.
I look at the aggregate. So there's one. So it's still 2 rate cuts overall by the end of the year.
Got it. Yeah. So while we have that fresh on our minds, why do interest rates matter so much? Let's talk about that. So I'm going to talk about it while I look at Zoom and do a conversation there. So you notice this number here, discount rate. That's the discount rate that I am discounting future free cash flows as well as future profits. The lower this discount rate, let's take this down to 1 and look where the value goes. Focus on intrinsic value here. When you lower the interest rate, it really, and it kind of broke the model. So maybe I went too far. Let's go to 6%. See how the value of Zoom just shot up when I reduced it by 2%. That's because the expected rate of return that the investor's saying, based on the risk, I want 6% rate of return from an investment of this risk level. I have been at 8%, kind of a equilibrium point for a good balance sheet, a business I believe in. I've been down to 7.5 on companies like Berkshire, Apple that are super strong balance sheets. But as we move interest rates down, I will be adjusting my valuations to 7.5, 7%, assuming we continue to go down. And when that happens, the value of these stocks goes up, especially small caps, because small caps tend to have their cash flows and their profits in the future. So that's why interest rates matter so much. And that's why the market's going berserk to the positive berserk level. While I'm talking about Zoom, and before I move into Zoom, anything you want to add there, Daryl, on why interest rates matter so much?
Yeah, I've looked at, as I'm heavily into real estate, I've done some correlation analysis, and it's pretty clear when interest rates are down, real estate REITs do much better. I mean, there's the correlation is there. So
Exactly.
that's really all I have to add.
Yeah, I have a 2.5% interest rate on this home. Now, I could have paid it off. I got the rate in the year 2020, but at 2.5%, I'm like, you're going to lend me money at 2.5%? I'll take it. And I've been making well over, because I put it into bonds, been making between 6 and 8%. So that arbitrage is a beautiful thing. Back to real estate, I bought real estate in 2010, 11, 12. Interest rates were far more favorable then. So if you're sitting on a 4.25 loan, your cash flow is so much better than these days. You're signing up for 7.25, 7.75 if you're an investor loan. Very different. So as interest rates drop, real estate prices go up, stock prices will go up, and even bond prices will go up. So let's talk about Zoom. I updated Zoom last night on the live stream. They had a very good earnings. Good job, Zoom. They grew their revenue by about 5%, which isn't breaking any records, but it is a good growth rate for a very profitable company. These guys are super profitable. They're buying back shares like crazy. They have close to $8 billion of cash on the balance sheet, just sitting there, looking pretty, earning interest, and they're buying back shares. The market cap of the stock now, after it's gone up, I think 9% last time I glanced, is $24 billion. You have a quarter of that value in cash on the balance sheet. So that's really interesting. So the stock, I think, is discounted by 56% based on cash, and based on earnings per share, 24% discount. This is not an overly exciting stock because they're only growing at 5. But overall, it's a pretty nice value stock in technology with a company that has 80% gross margins, super high net profits, and so forth. And I agree with you, Mike. Why would I pay off a 2.5% loan? I actually took that loan. A friend of mine does mortgages, and he gave me a super good deal on the fees and stuff. But I basically took like $300,000, and I've been making the arbitrage on that money, making, call it 7% on $300,000, and then I only pay 2.5%. Yeah, I'll I'll stick to that. I'm not going to pay it off anytime soon. All right. So Zoom is having a very good day. Glad to see it. Up almost 10% now. And glad I own it. I'm glad I own a lot of technology stocks, and I'm buying more small caps. I am been on a little buying spree for small caps, and I'm glad for it because as interest rates drop, it's going to look really good. Do you have any comments on Zoom? I'm going to give you the screen.
What kind of moat do they have?
So the moat, I would say, is that especially the consumer and small business has the user experience is best on Zoom. I think Microsoft has a very good application. I think they call theirs Teams.
Yeah.
And Google has a pretty good one. That's the one I use for member calls. But I think the Zoom experience is a little better, and experience on the software side really makes a big difference. And once you have an adoption rate that Zoom has, companies and people don't want to move. They like that experience. They don't want to be moving it. They meet their customers on Zoom, right? So you don't want your customer to be bothered with, hey, sorry, I just moved from Zoom to some other app, and maybe that one doesn't work out. There's kind of a risk level there. So I think the moat is that their network power is getting stronger and stronger.
Okay.
And their weakness is that they're a single product company, and that is a weakness. If you cannot start to grow into other parts of the software ecosystem, you're going to be isolated to just video conferencing. They've tried to grow to add like phone services, which they've done successfully, but geez, my use of my phone, I used to, like 20 years ago, it was like I was on my phone 4 to 6 hours a day, maybe more, maybe 7 hours on a heavy day. I was on my phone. My biggest problem was my darn battery would not last, and I'd have to be constantly plugged in to recharge my phone. Nowadays, with Zoom and everything else, I mean, I'm on a live stream with you. I call my mom on my phone. She's 89. I talk to people on the phone every once in a while, but mostly I'm talking to people on some kind of video conference app. WhatsApp is, in my opinion, better than phone service. So I'm on WhatsApp just as much as I am on a cellular, I guess a digital phone line. So I think the world's moving off phones, and Zoom is trying to grow a business where they're going to sell phone services. Well, not the best category to grow into.
Okay. So they are up pretty good today, 9.42%. Looks like they are about the same price before today as they were a year ago.
Mm-hmm.
The RSI is looking strong, moving towards the 70 line.
Mm-hmm.
The PPO is under the midpoint, so it hasn't moved into bullish territory yet. The momentum compared to the S&P 500 is better. The relative strength is underperforming the SPY a little bit. Good money flow, barely outperforming the S&P 500 by 1.4%. Underperforming the technology sector by minus 2.19%. Outperforming computer services, I guess that's their technology group, by 9, almost 10%. And that industry group is underperforming the SPY by 7. But it looks like they could be on their way today. They're trading above all their moving averages.
Excellent.
They just passed the 200 today.
Yeah.
That's good news.
Up 10%. You know, you end up breaking a few of the channels, right?
Yep.
Good. Very good. That looks excellent. Well, what other stock would you like to look at? Anything out there that you would like to look on this update?
We looked at NVDA. That was the only one, just in preparation for their earnings next week. So that's the only one that I had.
Tesla's up 5%. Can we look at Tesla?
Sure.
Let's walk on the wild side. Tesla's incredibly overpriced if you look at valuations, but hey, investors of Tesla are like, you don't look at valuations, you don't look at fundamentals. You got to understand the future of Tesla.
Yeah, it's still within their consolidation range over the past since May.
Mm-hmm.
They've been trading between 366 and 273, so they're kind of sitting right in the middle of that. They are trading above their 200-day moving average. Today it looks to be upward sloping. The 20 and 50-day also look to be upward sloping, and it's trading above those. It closed below those 3 moving averages yesterday.
Mm-hmm.
So the RSI is sitting kind of right in the middle at 56. PPO doesn't know what it wants to be, whether bullish or bearish, sitting right on the 0 line for the most part. The accumulation distribution is down a bit from its peak back in May. The money flow is sitting right on 0, so can't make up a mind whether it wants to be bullish or bearish. It is outperforming the S&P 500 by 37.59%, the discretionary sector by 25%, the automotive industry group by 5.34. You can argue whether they should be in the automotive group or not. And that group is outperforming the S&P 500 by 30.61%. That's a little surprising to me.
Mm-hmm.
So they're trading in a range. They can't decide whether they want to go up or down.
Yeah, isn't that interesting that they've just been in that range? Let me cut back to my screen. The stock's up 5%, and over the 1 year it's up 50%. That's a nice rate of return. Year to date's down about 16.6, and the PE is really high at 200. You know, a lot of investors would say, well, you shouldn't treat it like a car company. But as you know, I quickly get into financial statements because the financial statements to me are truth. It's like the most revealing part of a company. The CEO, they're paid to sell you the company. They're paid to sell you the future of that company. So I listen to that, but I pay most attention to their financials. And if you look at Tesla financials, what shows up is a high percent of their revenue is from car sales. So it's very accurate to call them a car company. If you sell cars, you should be called a car company. If you sell hot dogs, you ought to be called a hot dog company. You sell financial services, you ought to be called a financial services company. That's clear as day for me. Their market cap's $1 trillion. And I get that, a good portion of that value is a future robotaxi business, a robot business, and those things. If they pull that off, they may be worth $1 trillion, maybe more. But they have stiff competition. They're not the only robot company on the planet. They certainly are not the only robotaxi company on the planet. There's other companies that are ahead of them. And I think it's almost like sports where people pick their favorite team. They always look for their team to do well, no matter if the team doesn't have the talent that the competitors do. And in Tesla's case, when you look at robotaxi, they got a pretty good opponent, two good opponents. Amazon has Zoox, and Google Alphabet has Waymo. Those companies have plenty of capital. They have plenty of intellectual knowledge, ability, expertise. And Waymo has a big lead. You have that, and then you have the companies in China that are really advanced when it comes to robotaxi, and they are rolling out robotaxi in other parts of the world. So I'm not sure how the optimistic story on Tesla and robotaxi is not taking that into account, because they're not in the market by themselves. On the robot side, there are robot companies, and in fact, Amazon again has well over 1 million robots operational in their warehouses. So they have been developing robots, using robots, know robots, will likely begin to sell robots to their customers. And there they are. So all these stories, I think, again, the Tesla CEO, he's a rock star. He's paid to sell you the story of Tesla. That's why he's the richest guy in the world, is people buy his story. But I look at the fundamentals. And when we look at the fundamentals, it's telling me Tesla's not growing. Well, if it's not growing, why are we paying so much for this stock? Or I should say the market's paying that much. If, maybe it's your size. 92 billion is a pretty big number. Well, let's look at a company that's way bigger, and I just named was one of their competitors. Let's go with Amazon, since Amazon is doing those robots. So Amazon is more than 6 times bigger than Tesla. They're growing at 11%. So it's not a size thing. It's your cars are not as competitive as they used to be thing. And you could see the just heavy competition in EVs. So the CEOs wisely changed the story. Don't focus on fundamentals or reality. Focus on the future stories. And it doesn't, I'm a fundamental investor. I look at the financials. The financials tell me what the business is doing. You may give a business a year or two to kind of recover or grow a particular business, but this one here, boy, investors have to give it 5 years, maybe 10, to fulfill the thesis that they're trying to sell us. And when we look at the valuation, Tesla was the worst stock in my latest video, which is best and worst or worst stocks in the top 10 most valuable companies. Tesla was the worst stock that I could buy right now, because I'm buying it at a heavy discount with a lot of promises that they're going to be the number one robotaxi player in the market. They're going to be the number one robot company on the planet. Yet neither business is really real right now. Like the robotaxi business, they haven't charged one customer a fare, where robotaxi and Chinese companies are already doing it. Zoox is operational in Vegas, and Zoox is getting validated in Austin, San Francisco, and in a couple of other cities. So Tesla's competitors in robotaxi are ahead of it and putting a distance between them and Tesla. So we'll see how that shapes up. But interesting to see that Tesla is rising today when interest rates have been are going down actively and are expecting to go down over time. So Meta is up 2%. Great to see. Google, looks like Carlos has a comment. And Kathy Wood is long on Tesla. She's been long on Tesla forever. She's going to ride Tesla until it's worth $1 a share. That's her stock. She's not moving. And yep. And Saeed, you had a question on Coinbase that I'm going to go ahead and talk about. And then comparing Tesla against Xiaomi, I think that's a good idea. Shadow Guy, I'm going to do that. I'm not going to do it here because whenever I go to a foreign stock, it becomes laborious and I would say boring for viewers. So I'll do it on my own time and then create a video, or maybe add it to the next live stream. But I think it was who asked about Coinbase? It was Saeed. Yeah, Saeed. So asked about Coinbase. Let's take a look at Coinbase because crypto land is on the move. And the question, what is the moat of Coinbase? And I shared a video of the CFO and chief legal officer with Shadow Guy, I think yesterday. I encourage you to get familiar with Coinbase. Not the obvious business that they have is the crypto exchange. You can buy Bitcoin there. You can buy Ethereum. You can sell your Ethereum. You can have a wallet. All those things. There's other competitors. Got it. But where Coinbase is building their moat is that they're developing the infrastructure for crypto. For example, when a lot of these ETFs and other brokerages are offering Bitcoin, okay, they are depending on Coinbase to be the treasurer and hold those Bitcoins and hold those Ethereum coins. In essence, it's an infrastructure play for the brokerage. Additionally, as you see companies like Circle that came out, they have a stable coin. They are completely dependent on Coinbase. Coinbase views them as a partner. Coinbase makes a lot of their money makes a lot of money on Circle. Circle is the face to the market, but behind them, the infrastructure is Coinbase. Get really familiar with the infrastructure because that's where Coinbase is going to be the foundation of a lot of the innovations around crypto. And that's what's going to build their moat. They could become the Visa. You know how Visa is like this, they own their platform or their network, and everybody pays Visa for doing a transaction on their network. Coinbase is developing something like that. So that's the moat. And the more they build it and the more companies that build on top of Coinbase, the more valuable Coinbase is going to become. And that's not easy to understand. So I encourage you to watch videos, understand it. I'm going to find that video and I'm going to put it in the chat. And if you don't see it there, Saeed, email me and I'll get you that video. I encourage you to study that video and understand what they're building because it's not easy to grasp, and but it's really important. Coinbase is up 6.36%, 38%. It's fairly priced. I think I looked at it yesterday. It's probably priced a tiny bit too high. I own plenty of Coinbase. Would I be compelled to buy it on a pullback? Maybe, depending on how much it pulls back. Year to date, this is going up nicely. 1 year up really nice, 55. So that looks good. $82 billion market cap. PE ratio is 30. Analysts think it's discounted a bit. The growth is decent. The latest quarter, the growth wasn't very good because the compare was tough. The first quarter of this year had a lot of transactions for them. Then the second quarter wasn't as great. I don't know how the Q3 is going to be from a transaction perspective. But the whole big picture for Coinbase is why I'm a holder and I'm a buyer when it has strong pullbacks. So I really like Coinbase. Would you have some comments on Coinbase?
I don't, Victor. I'm just watching that 3x leverage.
Well, show that to us.
Okay, it's on the screen.
Is that your 3x leverage on small caps?
Yes. So this is a 15-minute chart that I watch, and as long as it's going up, I'll let it go up. I'll wait for it to turn over.
It's up
and then
11.6% today.
Yeah, I'll close that position out today.
Congratulations.
Probably at some point.
Sir. So you becoming a day trader, or what's going on here?
Only in small areas. So small caps is definitely one that I think has a lot of room to play. So I own a small cap ETF, just 100 shares of it right now because I think it's going to do well. Let me see how it's doing today. Yeah, it's up 3.74%. And then I just buy a lot. 100 shares when I say lot of this TNA on occasion. if I think it's going to have a move. I've only probably done 5 or 6 trades over the last year or so.
Very good. Nicely played. And what got you to think, hey, I want to buy into this? Did your spidey senses tell you the Fed's going to say something that is going to cause interest rates to drop and stocks are going to rise? Or what was your process behind your buy?
Yeah, I had a feeling interest rates were coming, and we looked at, or interest rate cuts were coming. And we looked at a chart yesterday. If we look at like the S&P 500, the long term, this is a long term, this is 20 years worth of data. We're sitting at the top of this trend channel. So risk is higher moving to the upside than it is to the downside. And then if we just look at a small cap, this is the S&P 600, which is very similar to the IWM, except they filter out zombie companies. You have to be profitable to be in this index.
Uh-huh.
So it's sitting at the lower end of the channel. We reached the bottom of the channel in April during the tariff announcements. And then we haven't even made our way back to the midpoint yet. So this leveraged, 3 times leveraged ETF, I don't ever hold it very long. Maximum is probably 10 days.
Mm-hmm.
So because it eats away at your capital pretty quickly. So anyway, I just had a feeling with that we were going to, get an announcement. I didn't know it was going to be as wild as it was today, but
the Russell 2000 is up 3.35% today.
yeah.
Woo-hoo. Go Daryl. Nicely done, sir. All right. So let's go ahead and wrap things up. I got to go look at my portfolio. So that's going to be a fun exercise. And I just wanted to mention Saeed. Here's the video. I posted it in the chat. Covers a conversation with the CFO and the chief compliance or chief legal officer over at Coinbase. And in that conversation, they talk about the infrastructure they're building. And I've been following that, and listen to the earnings call for Coinbase and listen to the CEO talk about how they want to do crypto as a service businesses that in essence are the foundation of businesses that are going to get started and innovate. So they're going to develop on Coinbase is in essence, and Coinbase will be a participant in those businesses of the future. So I think if you understand that, it makes you a better investor on Coinbase, and I think a better investor in crypto. If crypto's made it pretty darn far. The 10 years ago, crypto is like each Bitcoin was like, I don't know, $15, $50. Now it's 115,000. And it was like 99.99% of people were like, oh, that's a gimmick. It's doesn't exist. That isn't real. Charlie Munger, who I love, called it rat poison. Oh, that was good. And now some of the biggest non-believers, like JP Morgan's CEO, who sees that, oh, wait a second, if they're going to rebuild a lot of the foundations pieces to the finance industry, we got to be a part of it. So he's really bought into it. A lot of naysayers are now bought into crypto, which is a big U-turn for those guys. And guys like Tom Lee, a big stock investor, he is big into crypto. I'm not big into crypto. I own 1.29 Bitcoin. I own a little bit of Ethereum. I own Coinbase. and I'm good. It's not going to be a major part of my portfolio. Big part of my portfolio first is real estate. Real estate's my biggest net worth item. And then second is big stocks, Meta, Google, Amazon, Robinhood, those types of stocks. So take a look at that video. I think you'll be smarter for it, and listen to the earnings call on Coinbase. It'll make you smarter on crypto. Well, this was a fantastic live stream, Daryl. Thank you so much for co-hosting. Any last thoughts before we move on?
Well, happy trading, guys. Stay invested.
Exactly. This is why you stay invested, is on a day like this. You don't want to be on the sidelines. You want to see your portfolio jump up and you're like, cool, I'm going to go somewhere nice for lunch today. I'm going to get the extra guacamole if I go to a Mexican restaurant. All right, guys. So thanks so much for tuning in. We had a lot of viewers today. I really appreciate it. Consider being a paid member of my channel. I think you get a lot of benefits, including on these live streams. You can put tickers out there that will analyze. And please subscribe to Daryl's channel. I think you'll learn a lot from watching his videos. I look forward to seeing the video you're going to create. And we're going to stream again next week. We're going to do a watch party for the NVIDIA earnings. And then I'm going to see how often we can stream like this. It's at 9 a.m. Eastern, this format. I really like this format. I'm going to see as often as Daryl and I are available. I'm going to go ahead and schedule that in advance so you can visit the channel and see when it's going to come up next. But I really appreciate everybody attending, and everybody have a terrific day. Enjoy the real nice rally we're having on Wall Street.
Absolutely. Thank you, everyone.